Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Max Wasserman, co-founder and senior portfolio manager of Miramar Capital, to discuss why bonds and dividend strategies have become an attractive alternative in a higher rate environment. Max, it's great to see you again. Welcome back to Trade Talks.
Thank you for having me on.
You got it. Before we get into the strategies there, let's talk about the macro backdrop. We know inflation is persistent. Do you believe that the Fed will probably have to go through another couple hikes here?
Yes, actually, we've been calling for that for the past year and a half, and we think people are being a little short-sighted. Core inflation is still running very high. Consumer spending is running very high. And at about a 4% to 4.5% inflation, there's really no real return just yet, with 10-year bonds at around 4.5. So we think it's very sticky inflation, and the Fed, we believe, did a disservice by pausing. We think they should just finish ripping the Band-Aid off, do another 25, 50, and let rates adjust over time, because we think rates are going to stay higher longer than most people think.
Yeah, I mean, it feels like inflation is just so persistent that the only way we're going to get out of this is if they actually raise their inflation target, which probably is not the case here.
Exactly.
But you know, I mean, I feel like despite the high rate environment, the market has climbed a wall of worry. Yes, we've seen some retraction in the gains in 2023 over the past couple of weeks. But do you think at this point that multiples and estimates are still too high, or are they in line?
Well, we definitely think that they're too high. If you're looking at a 20 forward multiple and they're assuming a 240 on the earnings, keep in mind that, as everybody knows, this is a very concentrated market, with the Nasdaq really accounting for the majority of the return. If you look at the average equal weighted of the market, the S&P, it's only up about 5 or 6% for the year. And the Nasdaq, which was down 32%, is basically trying to retrench what it lost last year. But given the multiples right now, given the fact that the Fed still is tightening, it takes 3 to 6 months to work its way through the economy, 240, 250 on earnings for next year seem pretty optimistic to us. And given the high multiples that you have, and we're at higher rates than we've been back to 2000, we think the NASDAQ part of the market is just too rich given this current interest rate environment.
Let's talk about the consumer for a moment here, because it really continues to be a bright spot. We know that student loan payments are going to start to come due again. We know that COVID savings are starting to come down a bit here. What about the haves and the have-nots within the consumer space? What's being hurt, and are you starting, or are there any more bright spots there?
Sure. And we're going to define the haves as the upper middle class and the wealthy, and the have-nots as the middle class and the lower income class. And the have-nots, it's probably not a great term that I use sometimes, but we're looking at people who are more susceptible to inflation, core inflation. So where energy is a bigger portion, food cost, housing is a bigger portion of their discretionary income. And that's where we mean by have and have-nots. Have-nots don't have as much discretionary income. And so the daily living becomes much harder when inflation is very high. And you're starting to see that effect with credit card delinquencies starting to rise, a huge $1 trillion in credit card debt. Now, if you go to the people who they say who have more discretionary spending, you're starting to see them trade down. You're starting to see people go to less expensive goods. And you're also, the luxury good makers are starting to stop the increases in pricing because they think they've reached a certain level. Also, the fact that if you look at jumbo mortgages, I mean, right now you're over 7.5%. They're much harder. Banks, more of the regional banks are retrenching their lending. So if you look at it, core inflation's there. And that's the worst long-term enemy for the investor, is inflation. And if you think about it from the point of housing, food cost, and energy, inflation just eats away at their day-to-day lifestyle. And that's why we think the consumer is, yes, it's working through all the money they had. They're working through their savings. But with credit card debt the way it is, and the interest rates on that credit card, you're going to start really feeling it probably going into the third and fourth quarter of this year.
Mm-hmm. So let's talk about some areas that are attractive for investment. Let's start with bonds here.
Sure. We like, right now we like 1 to 3 year corporate and treasuries. Before, you couldn't get any interest, you got like 1.5% in a 10-year. But, for the individual investor who wants to stay liquid or short term, 1 year treasuries at 5.3, corporates 1 to 3 years out, they're getting 5.5, almost 6% on investment grade bonds. We think that's an excellent place for short-term cash. Now, we're not as attractive, we think, in the muni market, because municipal market is not as liquid as the corporate. And given the high discrepancy in the tax equivalent yield, believe it or not, buying taxable bonds is almost the same as buying the tax-free at this level. But we do like corporates, even money markets for those Money markets, you're getting 5.25 now. And for retirees, for the wealth, you need to park cash. This is a very valuable alternative than what it used to be years ago when they went into the stock market to get yield. So we think right now, corporates and treasuries are very attractive as a portion of the portfolio.
Right. And from an equity perspective, you're looking at companies that have the ability to maintain and raise their dividends, which kind of makes sense. I mean, if you have a cash healthy company, chances are they're going to perform better in the longer term anyway.
Exactly. You know, we look for companies that have the ability to not only pay the dividend, but increase the dividend. And if you look at it from that perspective, you're getting cash flow now in your pocket. So in a rising interest rate, you can turn around and reinvest at a higher interest rate. So you can live off the stock portfolio. And given the fact that people took such a hit last year in the market, they need cash flow. And while it's still, you know, looks like it's a good market so far, day to day, people can live off their dividends, right? People can use that to adjust, and they can also reinvest at higher rates. So we think companies that pay you strong dividends, again, it doesn't have to be high yield dividends. It could just be strong, steady dividends and increase are very attractive for the investor.
All right, Max, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much.